Joining me now is George Seay, founder and chairman of Annandale Capital. George, great to have you on.
Thank you, Caroline. Great to be here.
All right, first I want to get your reaction to the latest inflation data. July CPI came in tamer than expected, although core did come in slightly hot. The market seems to be taking it as good news. What do you make of it? Are you looking at it as glass half full as well?
I am. I think that when the market's priced for perfection, a lot of these obscure economic statistics that most people don't pay a whole lot of attention to, except for the professionals, start really splitting hairs and getting into granular analysis. And the result we got was not too far off what was expected, except for the core, as you mentioned. But I think it was just right for Wall Street. It was the porridge that was just right, not too hot, not too cold. Basically, you still have inflationary pressures to a small degree, but there's no evidence that tariffs are really jacking up inflation yet. But it's not so extreme that people worry about the Fed not cutting in September and for the rest of the year. It shows a strong economy, shows a healthy economy, but inflation not too hot so the Fed can continue to cut, and the market loves that.
Not feeling the impact of tariffs yet. This feels reminiscent of a few years ago when we kept hearing calls of a recession and it never actually came. Will we eventually feel the impact of these tariffs?
I think we will if they're across the board and they stick around a long time. I feel like this has been such an ad hoc exercise, and the president gives all these draconian issuances about tariffs related to our major trading partners. And he has brought the hammer down on India, for instance, but he hasn't on China, and he just extended them for another 90 days. And you look at this and think it's very ad hoc, and you wonder about the efficacy of singling out one country and not singling out another country. And then we've got the Russia talks coming up, and he hasn't brought the hammer down on Russia like he threatened to do as well. So it seems very arbitrary. But as long as it's kind of isolated and not across the board in the 20 to 30% range, it may not have as big an impact as people have been anticipating. But if he eventually brings the hammer down on Mexico and China and some of the largest trading partners, it will have an impact for sure.
So, given that there's still some uncertainty on that front, how do you think this report and then eventually PPI later this week will shape the Fed's thinking heading into Jackson Hole and, of course, the September meeting? Because I was taking a look at the CME FedWatch tool, and I'm seeing 94% chance of a rate cut next month.
Yeah, I think that these inflation numbers aren't enough to spook the Fed. I think that the employment number we got a week and a half ago was enough to give the Fed a green light to go ahead and cut in September, and probably cut later in the year at least once or twice too. But the data will tell the tale on that. But I would bet a whole lot of money we get a rate cut in September. It's a little bit overdue, I think, as well.
Okay, and you talked about the stock market being priced for perfection at the top of this interview. I'm curious about how you're approaching the market right now, given the impressive run-up that we've seen.
Well, I think it's a very interesting time when you look at millennials and Gen Z, young professionals who've been in the market for anywhere from 15 down to very few years. They didn't live through the Great Recession, and they didn't live through the tech bubble. And unfortunately, I'm old enough to have started my company right before the tech bubble popped. And I remember that market extremely well. And luckily, I'm more of a GARP investor. So we lost about half as much money as the market did during that tech bubble popping. But everybody lost money during that period of time. It was a 2-year horrible grinding bear market, and this market is eerily reminiscent of that. It's not as extreme as it was back then, but at the same time, value stocks and GARP stocks are much pricier than they were in 2000. It's only the tech bubble stocks that are not quite as expensive as they were back then, but they're still wildly expensive related to historical measures. And it's just hard to get excited about making double-digit returns every year for the next 3 or 4 years as long as prices are this high. Now, having said that, there's more margin out there than has ever been in history, and there's been quite a bit of short selling related on these high prices, so speculation is everywhere. But just because the market's expensive doesn't mean it's about to go down. It can stay expensive a lot longer than you can stay solvent if you're investing on margin. So it's a great time to be careful on both ends, the bullish end and the bearish end.
So if you're buying stocks, what are you buying right now? Because I understand there are still some unloved areas of the market that you like.
Yeah, I think that that's the key thing that people who are trying to put fresh money in the market need to really think hard about. If you look at Microsoft, their earnings were just spectacular, but the stock's kind of planed out since that happened. And then Google is kind of planed out after a big run right after earnings as well. And NVIDIA is kind of seems to be kind of capping out too. So when you talk about the Mag 7, or AI stocks are things that have been the most rampant with speculation and hot money coming in. I think it's kind of a tough time to get into them until the run up to the next earnings season in Q3. So I'd be looking at some things, and I'd say over the next 2 to 3 months, not necessarily right now, that will be victims of tax loss selling and that are significantly out of favor currently in the market. And I would put in that category United Healthcare, which has had all sorts of trouble this year and it's down about 50%, but is a blue chip gigantic mega stock. And I would also point people to UPS, which is trading at a very small price to earnings ratio and has a huge dividend and is a great franchise that's really having a hard time right now. And I'd also point people to oil and gas stocks. They are, again, tremendously out of favor. Commodity prices have come off significantly with the Russia peace talks and with the Saudis and OPEC Plus pumping a whole lot of supply into the marketplace. And you can pick up especially upstream natural gas stocks at a time when LNG and AI demand for data centers is going to push demand in natural gas tremendously for pretty cheap prices. But I would have a 2 to 4 month perspective on that. I would take my time and be patient about buying in because tax loss selling season is about to probably drive some of these even lower in the near term.
George, you were talking about Mag 7 earnings. When we last spoke ahead of earnings season, you said it could really have a dramatic impact on whether we have, I think you said, a soggy fall or if the market could continue to march higher. Now that we've seen so many of these reports come in, what's your update here? What's fall going to look like?
Yeah, Amazon got crushed after they announced earnings, and Microsoft soared, and it's been a wide variety. Meta soared, so it's been a kind of a mixed bag. But if you average it all out, I think the market got about what it wanted. It didn't get the euphoric, over the top earnings increase above expectations that it would take for the market to go up another 5 or 10% in the short term. But the market's remained stable, and it's probably about a point or two higher than before earnings season's really kicked off. So it's hung in there really well. So I think it was good, but not great.
Meanwhile, we did see the tariff deadline for China get extended once again. Now I think we're looking at early November until we might have an update there. Does that change your market view at all? I'm really just trying to get a better sense of if you think this rally is sustainable or if you think that we're due for a correction.
Well, I think we're due for a correction, but I've been wrong for the last month or month and a half on that. And trying to gauge the market and when it's going to correct or whether it's going to keep going up is a fool's game. It's impossible to discern that. I think it's ripe for a correction, but that doesn't mean it's going to happen. The market could rally into the end of the year as long as we don't get excessive tariffs or some geopolitical disruption like Israel bombing Iran's oil and gas infrastructure like they were held off on by the U.S. back when they were fighting just a month ago. I mean, you think about how quickly all these things change, or something dramatic happening in Ukraine and Russia. I don't see a whole lot of catalytic influences that would take the market heavily up or heavily down. I think we'll probably just continue to churn up into the right in a very measured, small way, unless something really disruptive happens. And part of that would probably be in the short term. And this is where it gets really nuanced and difficult to predict. You get economic statistics that show that we're slowing down dramatically. The market would probably take a short-term 5 to 7% hit, but then eventually the players in the market will come back around to the Fed probably will cut more aggressively if that happens, and that's bullish. So in the short term, it's really hard to trade a market like this. You kind of want to just have conviction about long-term investments that are anywhere from 6 months to 3 or 4 years, and stick with them and add to them if they get weaker.
Okay, George, finally, just quickly, you talk about potentially this 5 to 7% pullback. Would that be enough of a pullback for you to feel comfortable putting fresh money to work in areas of the market that aren't some of the unloved, beaten down areas that you mentioned?
A very small amount. We tend to layer in over time, and I get really like Warren Buffett, the old Warren Buffett cliche, be greedy when people are fearful and fearful when they are greedy. And I get really greedy when the market goes down 15, 20, 25% and use all my excess cash by the time the market's down 30. I just don't see anything that would send it down that much. So if we go down 5 to 7, I might put another 5 or 10% on, but that's about it.
Okay, we'll leave it there. George Seay, founder and chairman, Annandale Capital. Always appreciate your insights, and thanks so much for your picks.
Glad to be here.